Hello, my name is DrPaulCottrell, and I'm recording this on 8/22/2026. We're going to go over the yield and the public debt relative to GDP. But before we do, please go to my website, the-studio-reykjavik.com, and help support the work that I do. All these videos are for free. You can donate at the bottom of my homepage. You can donate through Stripe, Buy Me a Coffee, or PayPal. That way you're helping support the work that I do. You can also watch my broadcasts under broadcast radio or broadcast live. And I have many different products for my store. I'm not going to go into the details of each of the products, but we're just briefly go over them. I have ebooks about finance, economics, artificial intelligence, genomics. I also have great supplements. I have structural nanosilver products, gels and lozenges, toothpaste, and I have a very strong antioxidant called C60. You can get it in extra virgin olive oil, avocado oil, and MCT coconut oil. You can get it in a 2 ounce, a 4 ounce, or an 8 ounce configuration. I also have a lot of different supplements that you can take to help slow down the aging process, such as vitamin D3 and omega-3. Goodnight formula helps you to get into 3 to 5 cycles of REM sleep and deep sleep. Resveratrol that helps with youthful gene expression. Turmeric brings down inflammation, soaks up free radicals. Magnesium and zinc boosts up that immune system and helps with brain function. Zeolite helps to detoxify your body from heavy metals, toxins, and chemicals. Myotrol helps to build up muscle. Boomer Boost is a supplement that has lots of different minerals and vitamins and a lot of other supplements to help slow down the aging process. You can use this as a replacement to your multivitamin. Take it every day. It's dual purpose and it'll help to slow down the aging process. Collagen helps to remodel your joints, and super strong relief helps to reduce pain for arthritic joints and sports injuries. I also have ubiquinol, which is the most bioavailable form of CoQ10 that you can purchase. This will help to boost up the energy levels, help with the health of your mitochondria. NAD plus boosts up energy levels and helps to heal DNA. And nattokinase helps with your cardiovascular system, helps to break up clots, helps you to control your lipid profile. And I have curated boxes of for the anti-aging boxes and the longevity boxes. And they're at different price points. They're cheaper if you purchase an anti-aging box or a longevity box. But it's a great way to get healthy. For example, an anti-aging advanced box has Max 35, C60, vitamin D3, vitamin C, and magnesium toothpaste, and the probiotic. So it's a great way to get healthy. It's curated and it is cheaper to purchase the box versus the individual products. And I also have classes that you can sign up for under pulmonology and immunology. You get a lot of PDFs, a lot of videos on these different subject matters, and you get to learn about how the lung system works, but also how your immune system works. So please go to my store, the-studio-reykjavik.com, and help support the work that I do by getting the great products that I offer. And if you would like to donate, please do. With that, let's get into the curves. All right, this is from the St. Louis Fed. It's called FRED data. This is economic data that they published for free from the Federal Reserve Bank of St. Louis. Now, this is the 10-year over a period of from 1962 to the current. and it's measured in yield. So you can see from 1962, we started to inch up all the way through the Vietnam era. And then in these bars that are grayish, they are recessions. Okay. So you can see what's going on during a recessionary period. But the point here is that you have a curve that is moving from approximately from 1962 at 4.10, going all the way up to the high point in the in 1981 to 15.41. And then slowly, because of Volcker at the Federal Reserve raising rates, what happened was the rates started to fall. And it started to fall from the 80s, the 90s, the 2000s, and it kept on falling and falling and falling and falling. It seems as though we're moving towards a new regime. Now that inflection point looked like, all right, the lowest it's been, it was 0.55 at around 0.66, yeah, 0.55 or so. And we're talking about this is COVID time period where it starts to move upward. Now the question is what's changing this dynamic? It's obvious that we had expenses from the Vietnam era, we had oil crises. We didn't have a society that was as productive because of computerization didn't really take hold yet. And then the Reaganomics started to take hold. Volcker raised the rates, so we had rates that are starting to go down farther and farther and farther and farther. But it does seem like there has been an inflection point and a new regime is taking place within the 10-year bond market. So the question is what should we be thinking? Should this be inching back up to 15? Or should we be thinking that it's going to stabilize at approximately 5? You can see that back after 9/11, it dropped down a little bit and then creeped back up and then went just, hovered at around the 5 mark and then came back down. It peaked at around 2007. So we're talking about this area here is right before Lehman. And then Lehman happens, boom, boom, and it starts to fall even further. What's this dynamic? Is this debt from the government? Was it overspent fiscal spending because of COVID? Is it that there's a lack of productivity post-COVID? Are we spending too much money for social programs that are coming due because of the baby boomers? What exactly is this dynamic, and how far is this going to continue to climb? Now, people would say, well, we were at 15 back in the early 80s. It was pretty elevated in the 70s, and we seem to make it okay. But the other piece to this is the debt to GDP. And when we take a look at that period of time in the 70s when it's starting to go up, our debt to GDP ratio was below 40. So it was at about 35 and it hovered in the low 30s. Even during that spike in 81. And it was during the Reagan years, where our deficit really climbed up from the 70s of approximately low 30% of GDP to approximately, yeah, around 50. We crossed near the end of, it looks like at the end of Reagan's administration, we just crossed over the 50% mark. And this is the Cold War, financialization of our economies started to take hold. So that strong dollar was important also. And then it peaked at approximately 64. This is during the early days of Clinton. So 64, 65 peak for debt to GDP, and then started to go down back to the end of the Reagan years, or close to the end of the Reagan years, early Bush years. And then once like China gets into the WTO, the turn of the century, 9/11 happens, and it's just a steady march upward. So the question is are we productive? Are we a productive country? Are we issuing too much debt? Now, we could be issuing the same amount of debt, and if our economy is growing at a faster pace, we'll be able to bring this down. But even during the Clinton years, if we take a look at peaking at 65 and then coming back down to approximately 54, right? So you're talking about a 17% reduction, roughly. All right. And let's say we peaked now, which we didn't, but let's just say we peaked and we became more productive. Now you have to remember this period of time, this down, this debt to GDP ratio started to go down at roughly around the time where computerization really was starting to take hold and we were seeing productivity gains in the economy. Now, what's happening in the yields, the 10-year yield at that time period? The 10-year yields were at about 7.91 and then dropped down to 5.76 and then came back up a little bit. But it was definitely trending down at a good pace. But it is true that it was trending down in the 80s and even before Clinton during Bush Sr.'s tenure as president. But it became less, you can see that it was coming up and down, but it was less volatile. The peaks and the troughs were less compared to the early days of the 80s, where the peaks and the troughs were much deeper, much higher. So there was some stabilization. You can also see that there was stabilization starting to take place. The peaks and the troughs were less volatile, even as it was starting to creep up a little bit during Bush Jr.'s years. And this creeping up is probably due to the war post 9/11. But the point here is that rates were starting to go down, and our debt to GDP ratio was starting to go down by about 17% or so. Now it started to creep back up. And I think a big part of this is that we are becoming less productive society. We need to borrow more money. There was the financialization of our markets where we would buy cheaper goods from China and China would buy our bonds, and we were financing we were financing our deficits. And it just kept on climbing and climbing and climbing and more social programs. So we are way, way beyond our means. We're at approximately 22%, almost 23, almost 123. So we're at 122 to almost 123% of our GDP. And it started during COVID. That's when we broke. And now it did go back down. We were at 132 during COVID, and it came back down, but it's been creeping up again. So we are going to be retesting. We're going to be retesting that 132. Now we're at 122 at the moment, but so let's just say we peaked, which we didn't, but we're probably going to be at 140 or 150. But let's just say we peaked and we went down. And we went down 17%. We would see that we would be just above 100. If we went down, if we had some sort of productivity in the economy that warranted us to reduce, we became more productive, our economy was growing, our tax receipts were getting better, and we were issuing the same amount of debt or per year or a little bit less per year, we would see our debt to GDP ratio to go down, very similar to what was going on in 1995 to 2000. For that to happen over a 5-year period, we would, assuming it started right now, let's say because of AI, we became more productive, we had more tax receipts for the government, more inflows to the government, and we didn't have as many social programs and everything was copacetic. It would take roughly about 5 years and we would get just at 100% GDP. Now, this is a problem here. We're not going to be able to get back to those days of 60 or 80% or 60 or 80% of GDP. If we started becoming more productive society and we didn't need to borrow so much money, we would end up over a 5-year period coming back down to about here. But you can see on this chart, it's not going to be sustainable and it'll pop back up. Now, what makes it pop up? Recessions, wars. This climb here was because of the Iraq-Afghanistan war. This right here is the financial crisis. This is Lehman. This is COVID. This is the dot-com. This is that dot-com bubble time period. Right here is the recession that came after the Gulf War. So where's the capacity? Because you can see every time there's a recession, debt goes up. Well, where's the capacity if there's a recession next Tuesday? There isn't any, and so we have a higher chance to go to 140. And when that happens, you're probably going to see rates going up even further. Now, it is true that during a recession, rates seem to be going down because of intervention there's a couple reasons. Rates would go down in the 10-year because the Fed would lower rates. In addition, we would have individuals worried about the stock market, so they start to rush into bonds. And so there's a little bit of a lower yield on the actual 10-year. But we're not going to get to really low rates anytime soon here. Now, there is an added benefit that with a higher yield curve, it gives a little bit more cushioning capacity for the Federal Reserve to intervene. If you're near zero bound, the Federal Reserve has very little way to intervene. So there is a little bit of a blessing in disguise with this increasing yield curve. But the costs of homes, mortgages, car payments, credit card payments, everything is elevated. So this increase here from during the COVID years all the way to now for the 10-year, it's over indebtedness by the government. And recently, maybe a crowding out in investment for treasuries, where a lot of AI companies are issuing large amounts of debt. So there's less desire to get into the 10-year and more desire to get into corporate bonds. And this, big question about what's going on with tariffs under the Trump administration, what's going on with oil. Is it going to be staying elevated? So that might be inflationary. So these inflationary pressures that are taking place and the overspending of government of of government programs that's leading to this yield curve going upward. Now the question is, how far higher can it go? Now, if the 10-year stays at around 5, we're okay. All right, but if it starts to creep up to 7 or 7.5, we have a serious problem. Now, last time it was at 7.5 was in 86 and also approximately 1977. Oh, there was another one in 1994. So 1994, yeah, so 77.5, I think, is a breaking point here. So 1994, also briefly in 92, and then in 87, came back in 86, and then around 1977. So I'm very concerned when the 10-year reaches 7.5. Now, it's going to take some time to get there. But as it's getting there, you're also probably going to see a more creeping of our national debt to GDP ratio to go up. And now, I wouldn't be surprised that we get to 140, 132, let's just say 132 or 140 in the next 5 years, maybe even less. And we may see that our yields start to creep up faster to get to that 7.5. That means those car payments and those home payments are going to be a lot higher. So we have there's this inflationary pressure that's starting to build up in the system. Now, if there is a recession, a severe recession that takes place, then these yields will start to go down. There's going to be intervention in the market. But the issue is that our tax receipts will go down. So our debt, even if it's the same level per year, the need to finance the debt is going to increase because the tax receipts are less. And so our debt to GDP ratio is going to climb even higher. This is part of the reason why you have the debts rise after a recession, but they never come back down. So we were in a Goldilocks moment in 95 to 2000, and we do not see that slate mean reversion of about 17% anytime soon. So what's the big takeaway especially in the context of artificial intelligence? and all this investment that's going on with the hyperscalers. I feel that there's over build out of these data servers, and that Anthropic and OpenAI have not proven out their business model that it is scalable to a trillion or $2 trillion valuation. With that said, that would mean that eventually there's going to be investors wanting to get out of these types of investments. The AI trade will start to collapse. And when the AI trade starts to collapse, then the market's going to start to go down. People are going to panic. This is going to be like the dot-com bubble kind of issue. And then banks may suffer from their loans that they took out. But on the other side, the bank is also trading the upside of the trade and the downside of the trade, because they're long in AI right now, but they'll be able to short AI later, so they'll make money both ways. So it'll mitigate some of the losses with the commercial paper and some of this finance debt that's happening with Anthropic and Oracle. So I I sense that we're losing capacity to be able to absorb shocks, these financial shocks, with the oil issue in the Middle East, the elevated oil prices, the the inability for the government to be able to absorb a major financial shock, and the debt to GDP ratio is going to continue to go up. Now, short term, we may see yields to go down when the Fed starts to lower rates in in the future, when the economy starts to falter and the unemployment rate starts to tick up. But our debt to GDP ratio is going to continue to go up. So when we do get out of the recession, the bond holders, the vigilantes, are going to actually look at this. This is that we're still having an inflationary problem. I mean, when we look at inflation, inflation is at above 3%. Well, that's way above the 2% target by the Fed. Now, if the Fed can get inflation back down closer to 2, then we will see that the yields will start to drift down. So what's happening here is that the worry that the Fed is going to raise rates, and inflation, and crowding out because of so many companies issuing corporate debt, and the investors are buying it up because of the AI build out. But once that crowding out effect from AI diminishes, and the Fed can get inflation back down to 2%, this will start to drift down a little bit. Now, the question is, will we be able to get back to 2.5? It doesn't seem like we're going to get there anytime soon. It seems like there is definitely a movement upward since COVID, and it's just not stopping. Just like it was starting to creep up in the 60s and the 70s. And there was a little bit of a drop during the recessionary periods, but it took a very strong Federal Reserve Chairman, Volcker, to raise rates at the Federal Reserve at a very high clip to break that inflation and get the yield curve back down, coming down to to adequate levels. Now maybe, maybe 2.5, below 2.5 is just too low for a 10-year. And that there needs to be more buffer for the Federal Reserve. And I think there is I think that's a reasonable assumption is that the 10-year being this low during, right before COVID was, at the 1 or even 0.6, that's too low. We may need to be, at 2.5 or a little bit above for the 10-year. But the bottom line is this: we're way higher than we should be. And it seems as though we're getting closer. We're not that far away from 5. And you continue this on for the next 5 years, and we're looking at 7.5% on the 10-year. And we don't really have the capacity to bring it down using Fed policy, because Fed policy would have to raise rates and lower. If you raise rates, usually you cause a recession. Well, when you raise rates and you're causing a recession, we don't have the capacity to absorb that recession because of our debt to GDP ratio. We used to be able to. When we were at 30% of debt to GDP, or when we were at 50, or when we were at the 60 range, but we can't do that now. I mean, this debt to GDP ratio needs to come back below 100. Maybe at 80 would be a nice number, but it's going to take a long time to do that. So I feel as though there is the inability to absorb a shock, either a military shock, a financial shock, an energy shock, a climate shock. We're losing that capacity to absorb. And I don't see anything other than, if AI does work out and it gives us the productivity gains that we need, and it keeps employment up, we may see that 5-year trend down of 17%. Like we had in the mid 90s to 2000. But you're only talking 5 years for it to come back down. And if it started right now, we're talking 5 years later, and we would be at 100% GDP, roughly. So we're losing capacity to absorb shocks. It's a big takeaway from that curve. And that the yields are creeping up because we are spending too much. We have to finance our debt too much. And the Federal Reserve and the Treasury is worried about this. You can see that Bassett, the Treasury Secretary, he's trying to keep that 10-year below 5. He's concerned about it going above 5, because once it breaks 5, it's probably going to 7.5. There's momentum for that. So what does he do? He decides he's going to buy the 10-year Treasury and finance it with the front end of the curve. So he's raising rates in the front end of the curve, and he's trying to lower the rate in the belly of the curve to try to keep this rate below 5. Well, when he intervened, it worked that day, but the day later it came back up. So the intervention is going to work. The problem is too big for the Treasury Department to actually solve it. The real answer is that we have to start to trim down what the government spends. And we have to bring down our debt to GDP ratio to below 100, where this thing is going to continue to creep up and up and up and up. And the inflection point where this is going to start to move faster is at that 5% level. And the United States government isn't going to be able to finance its debt. More and more of its debt is just, our payments to our debt will be more to the interest. So it's really important to, to keep in mind this debt to GDP ratio is way too high. And COVID pushed it over the edge. We lost control of it during the COVID years, just like we lost control of it during the Lehman years. And it just kept on creeping up. We're feeling the effects of COVID and Lehman still. That where we're at with the debt to GDP ratio is heavily predicated on what was going on during Lehman and what was going on during COVID and failed policies in the Middle East. So this yield curve is probably going to keep on going up. And people that are looking for homes, if you want to buy in a home within the next 10 years, between now and the next 10 years, you better do it now because rates are probably going to go back up to 7.5. That means your mortgages are going to be maybe 2% higher than that, maybe 8 point, depending on your I think right now I think mortgages, fixed rates, I think are around 6.5, maybe 7, maybe 6.5. So we're talking about two percentage points above. So you're talking about 9.5 for a mortgage when we hit the 7.5 mark, roughly. This is all rough estimation. But this debt here is going to keep on continually going up and up and up. And if we were lucky and be able to bring it back down, at best, we're going to see maybe a 17% reduction. And it'll take over 5 years to do it. So this is a big problem here. So I think that as this is creeping up, the funding for AI is going to get more and more expensive because the yield, the demand for funding from the bond purchasers, they're going to demand a higher yield on corporate debt, which is going to be above the 10-year. And eventually the bubble is going to burst because they can't finance anymore. And then AI will see that tech crash that we had similar in 2000. But it's a little bit this tech issue, this bubble for AI, it's kind of like Lehman because you have to keep on financing it, or it all collapses. It's kind of like the dot-com where you had businesses that weren't really making money. Anthropic doesn't make money. It gets revenue, but it doesn't have profit. And it's kind of like the the railroad build out back in the late 1800s. A little bit of Enron too, with this special purpose vehicle stuff where they hide the debt. So it's a little bit like Enron, which is around 2000. It's like the tech bubble. It's kind of like Lehman because it's involving debt and the debt markets are going to collapse. And the railroads. So this curve is going to continue to drift upward towards 7.5. No matter how hard the Treasury Department keeps on trying to engineer something. Now, what's interesting is that Bassett comes in, buys the middle of the curve, finances it on the front end of the curve. The front end of the curve yields will creep up. And if his Treasury curve yield engineering works, then the middle of the curve will start to go down. Maybe the back end of the curve goes down a little bit, but what will happen is that the Federal Reserve is going to have to come in and lower rates. So it's there. So what's happening is there's going to be a neutralization that takes place. And when the Federal Reserve comes and lowers rates, short term, the yield curve will go down. So the 10-year may go down a little bit, But then what will happen is then the bondholders are going to start going, is this going to be inflationary with fiscal spending, with because if they're going to lower rates, if the Federal Reserve is going to be lowering rates, they're concerned about unemployment. And let's say unemployment starts to tick up, people aren't spending, there's a recession, tax receipts start to go down, and the debt to GDP ratio starts to go up even faster. And then what will happen is that more fiscal spending will take place. The bond holders will be saying, well, there's an inability to control inflation, and the yields will start to tick back up again on the back end of the curve. So I don't think that the Treasury or the Federal Reserve is going to be able to control the back end of the curve that well. And that the operations that took place by Bassett are going to be neutralized when the Federal Reserve actually lowers rates on the front end of the curve. So they're just playing games. The real answer to the problem is AI bubble has to burst sooner than later. Better to be sooner. So it doesn't put upward pressure through that circular financing on the treasury market and moving it closer to 7.5. The AI bubble needs to happen soon to prevent this from creeping up to 7.5. So I don't see, I'm not very positive about our debt to GDP ratio. This is gonna go above 140 before 2030. Plus, just take a look at it sociologically. Trump represents the 80s. Trump's whole being is this 80s yuppie-ish kind of lifestyle, living it up. But the debt comes due. The debt comes due. Think about what was happening right at the end of the 80s. The debt, there was a recession, you know, relatively mild, not that bad, but the debt kept on going up. And it was only through the computerization of the 90s that brought it down for 5 years, and then it started creeping back up because of poor economic policy. The government was spending too much. Plus, the baby boomers are going to be drawn down and becoming more expensive with healthcare and with Social Security payments. So, how are we going to get out of this? It doesn't seem like we're going to be able to. So that's my just overall take on the debt to GDP ratio and the 10-year treasury yield creeping up. And I think that whatever Besant did in the belly of the curve is going to be neutralized by just market forces, and it's creeping back up to the 4.7 range. And it's the Treasury is very worried about breaking the 5.0 mark. And the Federal Reserve, if the economy starts to falter because of interest rates are too high, they're going to have to lower rates. And that will bring down the front end of the curve faster. But the bondholders are going to still say, well, how are you solving the inflation problem? And that the back end of the curve is going to start to creep up again. The only way I see that we become more productive, and maybe technology will help us, just like in the 90s, and we need to reduce our social programs. We don't reduce the social programs, we're not going to get below 100% of our GDP. The debt to GDP ratio won't get below 100%. It's going to keep on creeping up and up and up, and it's going to be a problem. All right. So please Help support the work that I do by sharing the links. Ask your social media to follow me, and help support the work that I do by getting the great supplements that I offer. I have, again, a plethora of different supplements, and you take them regularly, it'll help to get you healthy, you'll have more longevity, and it'll help to slow down the aging process, bring down inflammation, soak up free radicals, and boost up your energy levels. So thank you for listening. Please go to my store, the-studio-reykjavik.com, and have a nice day.